Hello everyone, my name is Ryan Hughes and I'm Head of Active Portfolios here at AJ Bell, and I'm delighted to be running through the latest quarterly update of the AJ Bell Managed Portfolio Service. This is the first quarter of 2021. Time is absolutely flying by. So let's crack straight on. This will take about 20 odd minutes, and we're going to look at, we've got loads and loads of new investors, which is great. So I'm going to give a quick introduction to AJ Bell Investments. We'll talk about the MPS performance and markets over the first quarter, as well as what's been going on in the passive, Pactive and Active MPS. We'll talk about some of the recent changes and also our market outlook. So quite a lot to cram in this time, so we'll go quite quickly, but lots and lots of information for you, hopefully. So just as that intro, to AJ Bell Investments, as I said, lots and lots of new users of our MPS solution, which is absolutely fantastic. So thank you for your support there, and thank you for helping us go through the £1 billion assets under management barrier, which is a real achievement we're proud of over the last few years, and your support has been absolutely key to that. So we're very, very grateful for that over the last few years. And a very wide range of solutions now that we can offer for you, covering both passive and active, Pactive, the harmonious marriage of the two, funds, MPS, and also our recently launched responsible fund, and even more recently launched responsible MPS. I just wanted to spend 1 minute just introducing the responsible MPS, as some of you may yet to have taken a look at this. So the responsible MPS sits alongside our existing active and passive MPS, in that there are 6 low-cost growth portfolios, exactly the same as the existing proposition here, in that there are 6 growth portfolios, and these are absolutely designed for investors who care about people and the planet, but are still aiming to make a profit. And I think you've seen a big growth in the responsible space over the last 12 to 18 months. And we were getting asked by advisors and by our clients whether we could launch something to sit alongside our existing proposition. And so very recently we were able to do that. And one of the things we wanted to do was have a consistent approach to what was meant by responsible, which of course is a really difficult topic, as everyone's version of responsible or ESG or ethical is perhaps subtly different. And so to tackle that problem, we aligned ourselves with MSCI's approach to SRI, to socially responsible investing, by using their family of indices as a bedrock of our portfolio. So this brings consistently and hopefully reassurance that there is a consistent and robust approach to the responsible nature of our portfolios. Now, these are all invested passively, as I mentioned, tracking a wide range of multi-asset, a wide range of indices across multi-asset, depending on your risk tolerance. And I've put here on the slide what are the exclusions to give you a flavour as to the type of exclusions that are there. So where there's a zero tolerance, or whether there's perhaps a smaller tolerance where a company operates in lots of different markets and only has a small amount of exposure to a particular industry. So there's lots more information on our website about this. Now, importantly, just like any other AJ Bell product, it is a low-cost investment product, and our investment management charge is just 0.15% per annum. And bearing in mind these are invested passively, this gives a total indicative OCF of the underlying holdings and the management of it of between 42 and 50 basis points per annum. So really focusing in on that low-cost approach that we've had ever since we launched our first investment solutions a few years ago now. So as I said, lots of information on our website. I just wanted to do a quick introduction on our new responsible MPS to hopefully encourage you to take a look. So let's get on with what's been going on in the portfolios and how we're looking here. So lots and lots of performance numbers on the next couple of slides. I'm not planning on going through these in any real detail. They're more for you to take a look at your leisure. But perhaps what's interesting, I think, is to focus on the 12-month number, bearing in mind that pretty much a year ago now, we were near the bottom of the market in the depths of the pandemic, where there was huge uncertainty about what was going to happen. What's been really encouraging is how the portfolios have performed out of the other side of that. Strong performance across the board I would say, and also starting to see some good recovery in the income portfolios that I'll talk about later on, where of course dividends were really challenged this time last year when there was a wealth of dividend cuts and cancellations across the market. So passive portfolios, I think, performing very strongly, yes, over the short period, but also when you look at from launch, these numbers, when you compare them to perhaps the Investment Association sector averages or the Morningstar category averages, if you take a look at that in your own time, I think you'll be very pleased with what you see in terms of how these portfolios have performed. Now that's actually a similar story on the active performance here, and here the active portfolios, all of them performed perhaps a little bit stronger over the last 12 months as active managers have started to really start to find their feet again, in many respects helped by value managers performing better once the vaccine announcement was made in November last year, and we've seen that with strong performance over the last 6 months too. So the active portfolios went through their 3-year anniversary in February, and so for those of you that have that as a key metric, then now I think is a good time to take a look at the long-term performance numbers of our active MPS, and again, hopefully you'll be pleased with what you see. Last but no means least, on the performance numbers, just bringing the Pactive portfolio, which seems to be a very popular set of portfolios for advisors to use, where we're 50% invested in our passive strategy and 50% in our active strategy. Hasn't quite got the 3-year track record yet. We've gone through 2 years. Performance remains strong, as you can imagine, bearing in mind it's a blend of the other 2 strategies which are performing well. The Pactive numbers stack up very strongly too. All of these charged at the same underlying rate of 15 basis points annual management charge from AJ Bell. So good numbers there. Not going to dwell on those, though. Let's get into what's actually been going on over the quarter. And firstly, let's look at markets. Well, I mean, it certainly was a really interesting quarter, I think, for investment markets. By no means first, by no means last, is thinking about FTSE All-Share, with the UK again being at the top of the performance charts for the quarter. I should say these numbers are in sterling, as ever, so currency would have an impact if these were in local currency. But the UK market continues to perform well, and that strong recovery that's coming through after the vaccine announcement. And given the types of companies that make up the FTSE 100, it's perhaps no surprise with things like the energy focus, mining, and so on that have been driving that higher. Now, 2 other things to point out, I think. Firstly is perhaps the significant fall in the middle of the period from from emerging markets and Asia, which were led by China, and a real shift there, I think, where some of the stimulus in the Chinese market was withdrawn, and that very strong start to the year that we saw in Asia and emerging markets tailed off quite sharply in the second half of the period. There, obviously, these numbers are volatile, and we still see fantastic long-term attraction of markets like China, and I'll come on to that a little bit later on. And the other thing I think to point out here is the major change in the bond market, and I'll talk about this over a few slides here, but you're seeing right at the bottom there over the quarter, UK gilts down over 7% in just 3 months. And it was a similar picture for other parts of the bond market. Emerging market debt down 6%. Global aggregate, so bringing in mainly US treasuries, down 5%. This was a complete turnaround in the market. And for those of you that remember the taper tantrum of a few years ago, this was reminiscent of that. A really, really big move in the bond market, a big sell-off in bonds as expectations change. And yeah, it was exactly that. If we talk more about the bond market, and we'll look at a chart in a second. I mean, this is all about fears of higher inflation and therefore fears of higher interest rates. And this, in many respects, we should be quite pleased about this, because this is all to do with the global economy reopening. It's about thinking about the successful rollout of the vaccines, about us hopefully being able to go about our normal business again. I'm recording this today when people are able to go out for a haircut for the first time in 3 months, or are able to go to the pub, beer garden for a beer, albeit it looks like it's about 2 degrees out there right now. So I'm not sure how many people will be taking that opportunity, but it's a sign that things are returning to normal and that growth in the economy should pick up. If growth picks up, inflation is likely to pick up, and if inflation picks up, central banks might need to increase interest rates, and that's exactly what's filtering through into the bond market in those yields. We're also in the quarter seeing massive stimulus from the US, new President Biden sending checks, sending dollars directly to the population to boost spending in the economy there. So really, quite a radical policy that was started right at the end of Trump's presidency and was continued and expanded and accelerated by President Biden. So just to put that bond move in context by looking at a chart of the UK 10-year yield. We look at this chart a lot in our quarterly updates, as it generally tells you so much about sentiment in the market. And we can see that December 2020, so the last quarterly update we did, it was around 0.2% the 10-year yield on UK gilts, and that you can see how that has absolutely exploded wider and ended the quarter actually over 80 basis points, which of course is still not a huge number, but the magnitude of change over just 3 months is absolutely huge. And what we saw in one day in February, when US Treasuries were selling off, in just one day we saw a 5 standard deviation event happen in terms of the magnitude of the move in the yield of the US Treasury market. That is absolutely enormous in mathematical terms, and it's essentially one in about a 30,000 year event, if my maths are roughly right there. So the scale of the change was effectively unprecedented. But it's not all doom and gloom, because that was happening because, as we just said, investors are forward-looking and are thinking about what is going to happen in the second half of 2021, and beyond. And this is the US ISM Manufacturing Index. A number above 50 represents expansion. So we can see a year ago, doom and gloom, we didn't know what was going to happen. We were in expectation of the manufacturing market in the US contracting with a number nearer 40, and then a phenomenal rebound. And that has accelerated into the first quarter of 2021 and is running at about 65. So that is telling us that in the US, the people operating in the manufacturing index are expecting some very, very strong growth. And that's not unsurprising when you think people have been sent checks to spend, and vaccine rollouts happening, and people are being unlocked and are going to go out and spend money that they've been saving for the last year. So very, very positive signs in the US. Now, not all necessarily positive. I mean, it's interesting just to take a look back at China over the last year. Chinese growth, obviously something that's much written about and much talked about, and has consistently been above that 6% level, as you can see on this chart. Now, China, of course, effectively came out of the pandemic much earlier than the rest of the world. But even then, I think it's interesting to show the level of scarring that there was in the economy, where we saw annualized GDP in the Chinese economy at just over 2%. So much, much lower than we've been used to seeing before. But the Chinese government, the Chinese leadership are still expecting growth to recover to be above 6% for 2021 and 2022. So very much recovery to the norm is how the Chinese see it. And of course, if that happens, then that should be positive for Asia and emerging markets, and probably positive for global growth as well. So that's a look back in what's been going on around the markets. Well, what about within the portfolios? You've seen the portfolio performance numbers, but let's talk about what's been driving those and how that meant for some of the individual portfolios. So with that bond sell-off, it's clearly a quarter that was much more challenging for low-risk portfolios. Our low-risk portfolios have got a higher allocation to fixed interest, and there are a few hiding places when fixed interest is selling off so sharply, and gilts are down 7% in a quarter. So what that meant was our higher risk portfolios that had a stronger allocation to equities did well, but our more cautious portfolios, excuse me, well, we can. We've had a few questions and queries regarding the short-term performance of the cautious portfolios, quite rightly asking about that, and it's all to do with how fixed interest has performed over that very, very short period. Now, some of the ways to mitigate that is actually to hold short duration bonds. And so those of you that have been invested for a while in our portfolios will know that we don't own any standard duration gilts, UK gilts. We own all of our gilt exposure is in short duration gilts to protect against this exact scenario that we've been seeing. Now, short duration did that, but it wasn't able to make a positive return over the quarter. It was down a lot less than the 7% we saw in the broader market, but it was still down a little bit nonetheless. Away from bonds, in equities, we saw a continuation of the style rotation. Value had another strong quarter. We talked about this in the last quarterly update, where value had a fantastic end to the year. Well, it's continued that momentum into 2021, all based on the economic recovery hopes and these cyclical businesses that have really struggled last year, with investors hoping that they're now going to recover strongly. Asia and emerging markets we've talked about on the last chart there, and in the UK equities, well, very much a case of a higher oil price helping markets. The oil price was up around 30% over the quarter, and so that was positive for the big oil stocks in the industry, in the index, and was also positive for miners as well, who have also performed very, very strongly. So digging beneath the bonnet, the comments on the previous slide effectively telling you what's been driving the passive portfolios, which bits of the market have been driving the passive portfolios or have been headwinds. Now we look at what's been going on within the active portfolios with a couple of highlights, but also some detractors here. So value exposure has definitely been a positive over the quarter, as you can imagine. So the likes of Man GLG undervalued assets in the UK and Dodge & Cox US stock in the US, they've both significantly outperformed the index over the quarter and actually over the previous quarter as well, as they recover some of the ground that they would have lost last year. And for those of you that have listened to me speak before will know that we run broadly style diversified portfolios, so it's not a case of we're picking and choosing when to add value or take value out of a portfolio. We will have exposure to these broad styles over time here, and Man and Dodge & Cox both recovering very, very strongly. Interesting to see actively managed UK corporate bonds also performed well over the quarter, and this is really a lot to do with how managers are using the duration positioning to protect against a challenging market. So 24 corporate bond, to use one example, has got a little bit lower duration than the index, and that protected during the quarter, as indeed has the Artemis corporate bond fund. So both their active managers able to use their flexibility to outperform in a falling market, as we would have hoped. Schroder Asian Alpha Plus, picking another part of the world. We talked about Asia and China being challenging, but Schroder Asian Alpha Plus actually delivered another solid quarter of outperformance despite that volatility. Now, the fund has actually just gone through a manager change where the long-standing manager, Matthew Dobbs, has retired after a fantastic successful career and has handed over to his deputy of over 10 years to Richard Sennett. So despite the manager change, we've known Richard a long time, and we're very comfortable with that manager change and have no plans to remove that holding from our portfolio at all. A very, very strong, well-resourced, credible team with Schroders who have delivered fantastic returns for us. In the detractor side of things, we have exposure to a variety of currencies, and US dollars. Holding US dollars was painful over the quarter as sterling was stronger. And so that was a little bit of a headwind from us. And the thematic plays, which have been hugely successful over the last couple of years in technology and healthcare, took a little bit of a breather over the first quarter, say after some very strong performance. And just to pick on another specific fund, we talked about China. Allianz All China is the way that we expressed that in the active portfolios at the higher risk end. That was weak in Q1, again, after some fantastic performance in 2020. So that's a good roundup of what's been going on in the active growth and passive and active growth portfolios. What about the income portfolios? Well, it was good to see that the income style was back in favor over the quarter. And that was positive for the Income 2 portfolio, which has got a high allocation to equities, and many companies now returning to paying dividends. And so there's a much clearer roadmap for dividends in 2021 than there was in 2020. And so whilst 2020 ended with UK dividends down, I think over 40% in the end at a market level, then their market estimations this year are now for a strong recovery in dividends. Certainly not making it back all the way to where we were before, but we would be expecting to see strong dividend growth from the market in 2021 as companies recover, return to profitability, and are able to pass that back to shareholders. Now, some of our income strategies have got this value tilt that we just talked about, and they've benefited strongly from a pickup in sentiment, and this was true not just in the active, but also in the passive side of things, where there's more of a smart beta feel. So we've got some smart beta or rules-based holdings in the passive and the active that are able to get exposure to higher yielding stocks, but at more like passive investment management fees. And so we've made some changes to the portfolios actually to be able to maintain the yield in the portfolio, but actually lower the cost of investing. Now, as I mentioned, fixed interest was weak over the quarter. Now, clearly this is a headwind for the Income 1 portfolio that had a higher allocation to fixed interest. And I'll come on to some of the changes we've made recently in just a second there. But yeah, fixed interest was definitely a challenge over the quarter. So let's look at some of those changes that have been made. So in February, we updated our long-term strategic asset allocation. That's a process that we do once a year on a formal basis, and a number of changes were implemented. Now, I haven't in this presentation gone through all of the changes at a manager level. There is lots of separate information available on our website that can talk you through all of the changes that have been made and the rationale behind them. This is just a high-level change that has affected the active, the Pactive, and the passive growth strategies, and I've summarised it here in the interest of time. What we saw is that cash has been increased in lower risk portfolios, and that has a lot to do with the fact that bond yields are so low, and of course government bond yields in many countries are negative, and therefore not that an attractive an asset class to hold, as you can imagine. We've also been reducing fixed interest exposure, again much to do with low yields, but whilst we've been reducing the exposure, we've also added a lot to the diversification within our fixed interest allocation. So there are many different types of fixed interest strategy now held, be it from gilts into corporate bonds, into US tips, so into giving some inflation protection, to emerging market debt, both local currency and hard currency, US corporate bonds, a really wide range of different fixed interest strategies being held, bringing lots and lots of diversification to the portfolio. Equity exposure was broadly the same across the portfolios, but we have made a couple of changes where I think what looks really interesting on a long-term basis is to add direct China exposure and direct India exposure, rather than simply gaining this exposure through owning emerging markets or Asia. As you saw on the some of the previous charts, China is effectively dominating Asia, the Asia and emerging market indices now, and it makes up around 50% of both of those indices. And so we've reduced our exposure to Asia and emerging markets per se, but have added direct China and direct India, which we think will be, I mean, effectively in the next 10 years, you're talking about the number one economy in the world and what's likely to be the number 3 economy in the world. And we think on a long run basis, it makes a lot of sense to have direct exposure to these rapidly growing, enormous countries and economies that will dominate the economic landscape probably for decades to come. We've also added some specific sectors alongside our technology and healthcare exposure, and this has got a little bit more of a value feel to it than a growth feel that we have with the others. So we've added some energy, and that's been helpful to the portfolio. Energy shares were obviously very beaten up last year with a negative oil price at one stage, and really a struggling sentiment. That's completely reversed, and some energy has been added alongside some utilities as well, which has brought much more diversification again to the portfolios. And there's some other changes too, which I haven't gone into here in the interest of time. And just finally on this one, alternative exposure marginally increased, but with a focus on infrastructure, as we say there, as a long-term allocation within the portfolios. Within the income portfolio, again, the long-term strategic asset allocation has been updated, and at a headline basis, cash was unchanged over the period, no yield on cash, and therefore you can imagine that plays a very small part in our portfolio. But fixed interest exposure was significantly reduced in the Income 1 portfolio because of the very low yields on offer. So these income portfolios target a long-term yield of around 4%. Over time, and obviously fixed interest is yielding much lower than this right now, and so we've taken the opportunity to reduce the exposure to that, and as a result increased exposure to equities within the Income 1 portfolio, and with a much bigger focus on international equities, really with the thinking to make sure we've got a very broad spread of equities to have a nice diverse dividend generation approach. There. We don't want to be beholden on the UK, which historically has been a high yielding market, but that yield premium has reduced significantly over the last year. We want to have significant yield generation across the portfolio, across the world, from a very wide range of different industries and companies and geographies. And so we've taken the opportunity to reposition the portfolio as part of this annual asset allocation update. Alternative exposure was reduced marginally, and this has resulted in any property exposure being removed from the portfolio. Clearly, with everything that's going on with the pandemic and the continuation of people working from home and things like that, and our shopping habits changing, then the outlook for property continues to be a little bit uncertain. And we think on that basis, when we're looking to generate yield, that it's right to remove that from the portfolio. So that is a race through what we've been up to, what the market's done and what we've been up to. What about looking forwards? Well, I've talked a little bit about this as I've gone along. It's clear now that markets are pricing in a strong economic recovery. We're seeing markets hit record highs, and that is on the hope that in the second half of 2021 that we are going to see some very strong GDP numbers. And with that is likely to come, the market is expecting higher inflation and higher interest rates. Because of that, we would expect to see volatility in the bond market continue for some time. We've seen the Federal Reserve say to us last year that they were happy to let the economy run hot for a little while before they raise interest rates. So that's likely to see higher inflation, but the market is thinking that the Fed will have to raise interest rates before it really ideally would like to, if we get such strong economic growth, and that's going to have an impact on the bond market, we think, for a little bit longer to come. We're seeing this intra-market rotation move from growth to value as the economies look to reopen. That looks likely to continue, certainly in the short term. There's lots of these growth stocks were trading on very high multiples last year, very high PE ratios, and value stocks were trading on very low PE ratios. And we're seeing investors move from growth to value because they're essentially saying they think they can get similar levels of growth from the economic recovery from these value stocks as they can from the high growth, the growth stocks there. So we would expect that to continue certainly in the short term. But of course, whilst this is much more positive than it would have been a year ago or even 6 months ago, we need to be mindful that risks still remain in the market. This is all predicated on the successful vaccine rollout. It's about economies reopening. It's about all of us spending all of that money we've saved over the last 12 months in going out, going to the pub, going to the restaurant, going to the shops, and normal economic activity resuming. That is what the market is pricing in, and therefore any sign of any stumble around that will certainly have the potential to create some volatility and risk in the markets, and hence in those changes I talked about in the last couple of slides is much to do with making our portfolios add diversification to our portfolios from where we have been, and hopefully if we do get that volatility, then that broader diversification will help protect from some of the worst of that volatility, if indeed we see that during 2021. So that is about a 20-25 minute run through the portfolios there. So it's quite a quick, quite a lot to cover. There is written quarterly reports available, as well as a whole range of literature to support the MPS and indeed the responsible MPS that I mentioned at the start. So do take a look at our website there if you like more information. And I would say I would urge you to take a look at our long-term performance numbers against any solutions that you're using, alternative solutions that you're using, and take a look at how we compare. And if you want to discuss any of that, then we would be delighted to talk you through our NPS and indeed our funds in more detail, and reach out to any of your usual AJ Bell contacts, who will be very pleased to take your questions and queries. So that just leaves me to say thank you very much for listening to this update. I hope you all have stayed healthy and are well, and let's hope for a much more positive second half of 2021. And I look forward to speaking to you all again soon.